franchise financing solutions. You can do acquisitions. Sometimes people want to finance equipment with SBA financing because you get a little bit longer term. It's a 10-year term for equipment finance typically, versus going to an equipment finance company that just does equipment loans. You're going to usually be at a 3 to a 6-year term. So increased amortization is going to give you a lower debt payment. You can use SBA financing for remodels, rebuilds, and new locations, for franchises, for inventory, accounts receivable, for startups, etc. All right, well, welcome everybody. Today we're going to talk about how to launch, expand, or buy your next business using SBA financing, and all the tips and tricks that I can share with you in a short time period. So first, we're going to get started. We're going to talk about what is SBA financing? What type of loans are there? There's a couple different types of loans, and we're going to dive into some use cases. What you can use SBA financing for, and a lot more. So let's get started. All right, we're gonna start here with the SBA 504. Okay, so there's two main loans for SBA. It's the SBA 504 and the SBA 7A. The 504 is really geared for the real estate component. That's all it really does, is real estate and heavy equipment. Mostly CRE is what you're going to see this with. The 504 loan is essentially two loans. It's a bank loan, senior loan, and then the second lien is the SBA guaranteed piece. This is good because you can have a total aggregate of $5 million in SBA proceeds. You can have several SBA loans. But with the SBA 504 loan, what I like about this is you can do deals up to $18 million. You can have an $8 or $9 million senior loan, and you can have a $5 million second loan, $10 million senior loan, etc. So the second loan can always be a max of $5 million because that's the SBA guaranteed piece. There's two underwriting processes for this. It's going to be underwritten by the bank, and it's also going to be underwritten by a CDC. A CDC is essentially a nonprofit. There's certain CDCs, and there's a couple CDCs that lend in California. So the package goes to the bank. It also goes to the CDC. And so it's a little bit more time consuming than the 7A. The reason for the 504, you can do bigger deals, and oftentimes the rates are a little bit better. For example, the rate comes out every month for the 504, which would be the second piece, the guaranteed piece. And today that's a little bit over 7%. And once that loan is funded and the debenture happens, that piece of the loan is fixed for 25 years. It's a 25-year term. Now the senior loan, that's going to vary by the bank. So it's going to be negotiated with the bank or credit union or non-bank SBA lender. But the bank typically funds the first and the second. And then after the close, and if there's a certificate of occupancy because there's construction, the debenture happens. That's when the guaranteed portion or the second lien essentially gets sold off in the secondary market. So the 504 has its uses. The 7A is definitely more flexible. It can also do commercial real estate. You can do business acquisition as well with no real estate. All right, so here, and go ahead and type as we're going. Feel free to type in the Q&A any questions that we have. The 7A is a much more flexible loan, and it's typically underwritten at the banks. So we usually work with PLPs, which are basically they're designated to originate and underwrite the deals and draw docs in-house. So it never has to go to the SBA for underwriting. Now there's certain banks, credit unions that are not delegated, and they would actually have to send in their package. But typically I work with most PLP banks. And so it's a lot easier to get deals done with these banks. So the loans on a business acquisition, the loan is 10 years with no real estate. If there's real estate involved, the amortization can be as long as 25 years. Maximum loan proceeds are typically is $5 million total aggregate. You can have several loans that equal $5 million, but you're capped at $5 million. This is used for commercial real estate. It could be used for, non-collateral deals. You're buying an existing business, you're buying an HVAC company with no collateral. What else is there? If the term's greater than 15 years, then there's going to be a 3-year declining prepayment penalty. On the 504 loan, which I previously talked about, the second lien, the SBA guaranteed piece, has a 10-year declining prepayment penalty. So typically, if there is commercial real estate involved, we're going to weigh the pros and cons of the 7A versus the 504, which would be easier, why one or the other. Sometimes on value add type of plays, like you're buying a boutique motel and it needs a bunch of work, we're going to go into a 7A, and then because it's only going to have typically a 3-year declining prepayment penalty, and then we're going to do our value add. We're going to get occupancy and income raised and stabilized, and then we're going to refinance into a better product down the road. The 7A loan is typically priced based on Wall Street Journal Prime plus a margin, and then that's your fully indexed rate, and that changes based on the prime rate. I'm going to give you an example here. This is an example of a deal that can be done. So this is a franchise startup. Okay, so on a franchise startup, you have your franchise fees, your rent for the year. So this all tallied up, and if you look at the bottom, we look at total project cost. What's beautiful about this, let's just say this was an HVAC franchise startup. So we got a total project cost of $178,600. And you're building in working capital of $50,000. And if you look at my example, if we were able to get you 90%, so SBA guidelines allow for up to 90% on this SBA 7A loan or the SBA Express loan. So essentially with an equity injection of $17,660, you're able to close this deal. I actually just closed a deal. The gentleman bought a startup franchise, which was a painting company, and his total project cost was $115,000, and his equity injection was just $11,500. So you can see these loans are very amazing because of the high leverage, right? You can get in. So I often preach to people like, look, it doesn't take much to get into the game, because you can do a business acquisition, you can do a franchise startup. Depending on the total project cost, you're going to come up with roughly 10%. Now, sometimes the deal's got here on it and you're doing a business acquisition and the cash flow doesn't support. Some banks are going to lower the leverage to 85% loan to cost or 80% loan to cost. But when we talk in SBA, we talk about total project costs, because we can lend up to 90%. So here's some tips to improve chances of getting SBA approval for franchise financing. On startups, it's very, very important to create a good business plan and be really detailed. Because remember, that underwriter at the time doesn't know who you are, what you've done. So you want to show, for example, we were doing a laundromat startup, and we went back and really worked on the business plan, because a laundromat startups typically have a high failure rate. And so you really got to build a plan, show the demographics of how many, what's the foot traffic. There's a lot of sources too. I can help give you some information, how to get demographic information, which is critical. So the business plan is key on specific to the startup business, not a franchise startup, but actually a startup non-franchise. Then we're going to do 3 years of projections. We're typically going to break the first year projections down month to month. On year one, we're going to showcase the market research. Typically, you want good personal credit, right? You need 660. There's no minimum per SBA. SBA has like a 1,000-page document called the SOP. The banks all use this as their kind of guidance, but each bank utilizes what they call prudent lending, and they have to make their own decisions. So there's some banks that don't overlay what the underwriting guidelines say, and some overlay those completely. So it's across the board, and that's what I help you do. Is I help you kind of navigate and figure out what bank's going to do the deal. So can these loans be just for real estate? Yes, they can be for real estate, but it has to have a business component. So it can't be for investment. So if it's an actual business, like self-storage, they consider a business. This is a good question. But multifamily is not a business; that's an investment. So anything that's a business that you're going to run and as an owner operator is feasible. A convenience store, gas stations, things like that are SBA eligible, but not investment properties like real estate, like multifamily. Excuse me. Turnaround time for SBA financing varies. Depends if there's a commercial loan component, because then we need appraisals and environmental reports versus just a business acquisition. But we just closed a franchise deal in about 3 weeks. So they can be done very quickly. Some can take as long as 4 or 5 months. Just really depends on the deal and how many moving pieces and parts there are. Sorry about that. Just want to hit those questions. All right. So good personal credit. There's no set minimum, but if you've had bankruptcy or foreclosures in the past, bankruptcies typically need to be seasoned for about 7 years. Foreclosures probably about that same time, but there is no set. If there's a good story around it, there's certain banks that will overlook not having the 680 credit score. But I always tell people typically 680 or better makes it a lot easier to get the deal done. All right. And then they look at there's a form called Form 413, which is a SBA personal financial statement. So obviously, the better the financial statement looks, that's always a good thing. And then personal credit, and then resume of the borrower. What have they done? Have they been in entrepreneur world? Have they owned businesses? Have they managed businesses in their W-2 job? Are they keeping their W-2 job and also owning this business? This is all the stuff we cover, but I just want to give on today's workshop, I really just want to give like an overview to get your mind open to the possibilities of SBA financing, because really it's a remarkable tool that we should all be looking at using. Franchise financing solutions, you can do acquisitions. Sometimes people want to finance equipment with SBA financing because you get a little bit longer term. It's a 10-year term for equipment finance typically, versus going to an equipment finance company that just does equipment loans. You're going to usually be at a 3 to a 6-year term. So increased amortization is going to give you a lower debt payment. You can use SBA financing for remodels, rebuilds, and new locations, for franchises, for inventory, accounts receivable, for startups, etc. Ways you can finance a franchise acquisition is there is equipment financing. Sometimes we use that in conjunction with SBA. If there's a real estate component, we could do the SBA 504. Oftentimes, if you have an old 401k that's eligible for a Rob's rollover, you can use that as your equity injection, and that's a really good tool to utilize for your equity injection. Sometimes people buy franchises with unsecured term loans, and also sometimes they have a lot of equity in their own real estate and they put a HELOC and use that. There's certain rules you got to be aware of. Equipment financing is also, a big item that is funded by SBA financing. So depending on what you're financing, SBA in conjunction with equipment financing, or SBA that just finances 100% of the equipment, or sometimes we do a combination of both. So with the SBA financing, you can finance up to 90% of the total project costs. With the 504 loan, it sometimes varies. If it's a startup, they give you a 5% haircut. And if the property is considered a special purpose property, they give you a 5% haircut. So if it was a startup that was a special purpose property, which is basically the property really only has one use, then you'd be at 80% loan to cost. There used to be a franchise directory, it no longer exists, which would basically pre-approve certain franchises for SBA financing. That got eliminated amongst many other rules that have changed. Advantages of SBA financing, we've kind of covered a good chunk of it, that you can structure these deals with 90% bank financing. And that other 10% could potentially be financed by the seller. And we're going to get into that in a little bit. So really you can come in with less than 10% if you can structure these deals in certain ways. A disadvantage of the SBA loan is that if the loan amount's over $500,000, the SBA guidelines say that the lender needs to look for additional collateral. So if we did a $700,000 loan and there was no collateral or real estate involved in the deal, we have what's called a collateral shortfall. SBA guidelines then, because the loan amount's over $500,000, that bank would definitely look to put a second lien on a primary residence or a rental property. So you got to keep that in mind if the deal's going to be a larger loan and there's no collateral with it, there's going to be a collateral shortfall and they're going to look for additional collateral. Now, if you don't have any other collateral, that's okay, because doesn't mean they're not going to do the deal. But this is the stuff we unpack in our discussion. And I should preference what I do in the equation. So I help you navigate the whole process. So I work with banks, credit unions, non-bank SBA lenders, and I help you figure out what bank or credit union or non-bank would be the best fit, who's going to get us the highest leverage, who's going to get us the best cost of capital, and how we're going to get the deal done. Because you could take a deal to one bank and they decline it. You take it to another bank and they love that deal. You can take it to one bank and they say, yeah, we'll do the deal, but we'll do it at 80% loan to cost. You take it to another one, they'll do 90. It varies greatly in this world. And actually, for anything SBA, unless it's a small loan under 300,000, I don't charge fees. I get paid a referral fee. If it's under 300,000, there's one or two banks that I do charge a packaging fee because they don't pay any kind of referral fees. The 401k rollover, if you have and I have an expert that I have two expert companies I work with that specialize in the 401k rollover. But let's just say you had an old 401k and it was eligible. Typically, you can't use it with a current company if you had a 401k with a current company, but you can actually roll that into a self-directed vehicle that could fund your down payment or your equity injection. Potentially, if you had enough capital, it could pay for the whole business. And it's really a great tool to utilize, or at least look into doing when you're looking at buying into businesses and figuring out how you're going to come in with the down payment. I just wanted to touch on this today. Sometimes people don't want to go to SBA because they're not looking to do any sort of full doc loan, and they'll look at unsecured term loans, which is an option. So there's partners that we work with that will actually go out. If you have a current W-2 job, not related to the business you're buying, they can actually, based on your DTI, they can go out and get you unsecured term loans. Sometimes for these smaller deals, for whatever reason, they don't want to go SBA. We'll sometimes structure these unsecured term deals. And can you use a HELOC for your down payment? You can, but there's some rules with SBA, and the rules are you have to have outside income that can debt service that HELOC. So that's the rule. That's the caveat. But if you had a bunch of equity in a property, you could put a HELOC. You can use borrowed funds as long as you have outside income not related to the business that can debt service that borrowed funds. So oftentimes people will use a HELOC for their down payment or their equity injection for the SBA loan.
Are you trying to escape the W-2 rat race? Or have you always wanted to own your own business? Have you ever thought about owning a franchise? If so, FranUniversity.com can help. Our training program teaches you everything you need to know about franchise ownership, from choosing the right franchise to launching and running your business. We have the resources and specialists to help you from A to Z. You'll gain the skills and knowledge you need to succeed as a franchise owner. The best part? It's free to join. Go to FranUniversity.com.
All right, tips and tricks for SBA financing. Before I go there, I think there was a question. Good question. Is purchasing an existing franchise looked at more favorable with SBA loans or not really? So if you were to go and start a business that was non-franchise versus start a franchise, it's much easier to finance the startup franchise than a non-startup franchise. Business acquisition, I think they're about the same, because when you do a business acquisition, we always need 3 years of sellers' business tax returns and a year to date. So that's what we need from the business. And on any kind of startup, we're going to do a projections and a business plan. So they're underwriting the deal based upon our projections. This is the revenue, top line revenue. Here's our expenses. This is what it's going to look like. And they can finance up to 90% on a startup as well. Not all banks will. Some will say, hey, we'll do this deal, but we're going to do it at 70 or 80% loan to cost. But buying an existing business is typically easier because it's already got the cash flow, right? We got 3 years of financials. It's strong cash flowing business. But the banks really love franchise startups. They're pretty easy to finance, depending on what type of franchise. Tips and tricks for SBA financing. We've got, all right, so we're gonna start with full standby. And full standby, all right, so what does that mean? So you're doing a business acquisition, and the total project cost of this business acquisition is $1 million. And we've got the financials, the cash flow from the business is great. It supports our new SBA loan. So the bank's going to lend $900,000, which is 90% of the total project cost. So that means we need a 10% equity injection. Okay, so that 10% equity injection can potentially be a seller carryback. So as long as the seller carries on full standby, which means for the first 2 years, they can't take any payments. It can accrue interest, but no payments. That's called standby. So in the past, we would see like a 5% on full standby. So then you would come in with 5%, right? So this you get 900 grand finance from the bank, 5% on standby from the seller. So he or she is carrying back 50,000, and then your equity injection would need to be 50,000. We can go as high as the SOP, the guidelines for SBA now today say they could do all of it could be on full standby. Now, not many banks are going to do that. I've seen banks do 7.5% on standby, and the sponsor, the buyer of the business, came in with 2.5%. So on that $1 million deal, they came and closed with $25,000. So it's very powerful. Now let's go back and let's just show you another way here. So 900,000 is funded by the bank, 50,000 on full standby from the seller carry, right? Now we need 50 grand. I own 100. I was going to own 100% of the business, but I bring in another partner, and they own less than 20%, and they put up the 50 grand. Let's just say they're getting 10% ownership in the business. I came in with nothing, and I have an investor partner that owns 10% of the business. So we do those all the time. So as you can see, the SBA financing is amazing. I just went and bought $1 million business with none of my own money, or 50 grand out of pocket, or 25 grand out of pocket. That's the power of this. That's the power of the business acquisition. On a franchise startup, or a startup in general, same principle, right? You potentially could bring in a partner. Now it typically can't be borrowed from that person. It's got that equity injection needs to come, and they need to be owners in the business. But if they own less than 20% of the business, they don't have to go. They don't have to be a guarantor of the loan. They don't have to go on the loan. So we structure deals like this all the time. Before we go into partial buyout, I'll just handle this question. Is it okay to be an absentee business owner when I'm seeking an SBA loan? Not really. So it can be, but you have to structure it in a way. So let's just say you're in California and you're buying a business, you want to buy a business in Texas, which is and you have experience in whatever that sector is, and you're buying a business in Texas, and it's business acquisition, existing business, they want to see that you're going to actually live in the vicinity or have like a plan to move there. If you're just doing it from a pure investment standpoint, they don't like that. So I would always suggest a business in the area, because if you can have a manager run it, but if it's like on the other part of the U.S., then it's going to be a little bit hard to sell. So find something in the vicinity of where you're at within a reasonable drive. That would be my suggestion. Somebody just raised their hand. If you could just put your question in the Q&A, that would be very helpful. So we can go in and keep going here. So partial buyout, here's another strategy. You find a seller, all right? There's so many baby boomers today that are retiring that own businesses, and most of them don't have succession plans, meaning they don't know what to do. They're either going to list the business or try to sell it, or they're just going to shut it down, and just because they just, maybe they're having trouble selling it. Well, you can go in and do a partial buyout. So that owner could leave some of their equity in. They could stay as an owner. So they were 100% owner. You, the buyer, comes in and say, hey, I'm going to own 81% of the business. I'm going to get an SBA loan, give you a partial buyout. You keep your 19% of equity in the deal, and you stay on as owner, and you'll get cash flow, and you can help me as I transition into the ownership. So you potentially could do partial buyouts with very little money out of pocket, because you're leaving essentially a bunch of the equity from the seller end. A lot of times the sellers of these, like the businesses, are their babies. So they want to stay involved. And this is a way that you can come in and get in there with little to no money out of pocket. They can stay in and make sure, their employees that they've had for the last 15 years are still treated well. They can be a resource for you, because they're going to be fishing or golfing the 2 or 3 days out of the week, but they still want to be part of the business, and they want to help you run it more as an advisory role, or potentially they have a contractor's license, and you need that type of license to keep the business, and they'll stay on, and that in order for you to run the business without you having to get the license per se. So there's a lot of use cases. So this, in the olden days, this just recently changed. In the olden days, the seller had to be 100% out of the deal. So now they can stay in as a partial owner, and now they don't have to guarantee the new loan that comes in. So that's a great little tip. Investor partners, that's what we talked about, right? Like you could be the operator of the business and then find an investor partner that puts up the equity for the deal, and then you get the loan in your name, and they come in with the 100 grand or 200 grand needed to buy as the equity injection. So we do those all the time, right? So as you can see, you can be really creative with all these. Now, expansion loans. Here's another big one. Expansion loans. If you have an existing business and you want to expand, you can get up to 100% financing from the bank. So if you've been in business for over 2 years and your business tax returns and your credit and everything check out, they'll finance up to 100% of total project costs on the next deal. So I have a guy doing a laundromat right now. He's had the business actually a little under 2 years, but they're treating it as an expansion, and he's going to get 100% financing on the. He's going to go rent or lease a building and spend a couple $100 grand putting in laundromats and so forth. So you can finance potentially up to 100% on an expansion. So the other thing too is, let's just say you own a business right now. You're a CPA. I'm just making this up. And you've been paying rent for the last 14 years, and you want to go buy a building. Some banks will do 100% rent replacement, so they'll fund 100% of your acquisition to buy the building, so you can go own the building instead. Now, when there's commercial real estate involved, you have to occupy, you the owner operator of this business, your business needs to occupy at least 51% of the space. Okay, and we don't, even if you're renting some of the space out, as long as you occupy 51%, but we're not going to use that income from the other 40% 49% or whatever, it'll count in your global cash flow, but your income needs to debt service this for your business. We can't use their income from the rental of this building you're buying. So I can cover that in detail, but essentially your projections, your business cash flow needs to support the SBA loan, regardless of this other $5,000 a month in lease that you're getting. Now it's definitely a compensating factor to have that. Now, if you're building a ground up construction, you need to, from the onset, you have to occupy at least 60%. And within the first couple of years, I think it's 3 years or 2 years, you have to occupy 80% with the intention to occupy 100% within the first 10 years. The different rules on new construction versus moving into an existing building.
Hi, this is Bo Eckstein, host of the Investor Financing Podcast. Are you a real estate investor with properties and you're trying to figure out how to refinance or grow your existing real estate business? Need some clarity and a game plan for moving forward? I'm offering a free strategy call where we dive deep on your real estate investing goals. I'll help you come up with a strategic finance plan that will help you get to where you want to go. Whether you've got a portfolio of 30 properties or you're starting out with your first property, I have a framework that has helped many investors grow. If you're interested, book a call below in the Calendly link.
Let's talk about items needed to get approved. It's gonna vary a little bit differently. And somebody else, sorry, before I dive into this, somebody also asked, will there be a recording? I think they had to go. Yeah, there'll be a recording. I'm going to put it up on my YouTube channel, and I'll send it out too. I'll send it out to everybody, but I'll upload it. I'll probably edit it a little bit and upload it to my YouTube channel. And if you're not subscribed to my YouTube channel, please do go to investorfinancing.tv. Takes you to my YouTube channel and just subscribe there. Investorfinancing.tv. I have probably a couple hundred videos on SBA financing, business acquisition, franchise financing. And I will touch on this that so over the years, I've been in lending for 25 years. Started as a residential mortgage broker. The downturn happened in 2007. I got into hard money lending. Then I got into commercial lending. Then I got into SBA lending. And then through my SBA lending, people would reach out, and I really got into kind of funding the business acquisition. And then people would come to me and they'd say, "Hey, I'm trying to buy this Wetzel Pretzel franchise." And then I started asking questions like, "Well, why this franchise?" And they're like, "Well, I like the pretzels." And then I started kind of diving into it, and I learned about the franchise industry in a deep level. And I actually went through a lot of training. And we have a team that we set up through our company. I've got mentored by some of the best out there. And we help people that are interested in looking at franchise startups and resales. We help them in that space. I have two of the top franchise consultants that work on my team. One of them was my mentor in the space and still is. So if you're interested in that, we can help you. We can actually help you identify business models that make the most sense based on your available capital, your skill sets, your time, your lifestyle. We have a matching system we use. We have you take a short 10-minute assessment, and that helps us as we go through. But there's a lot of franchise business models that are not brick and mortar locations. Okay, they're home-based business models, very low employee count, great revenue potential, reoccurring revenue. We do a lot of events on franchising. I'm heavily involved in that space. I'm heavily involved in financing a lot of business acquisitions, and I still finance, commercial real estate and so forth. That's just a little bit more about me, just so you have kind of a background of how we can help you. Timeline for funding. If it's a franchise deal and it's a smaller deal, we can get them done as quick as 3 weeks. Most deals are 60-day deals. If there's a lot of real estate and there's a lot of construction involved in it, that could be a 5 or 6 month deal, a 4-month deal. It just really depends. Most of the time, it's not the lender, it's the borrower not being prepared. They don't have plans. They don't have the contractor, right? Like these are all, depending on what you're doing exactly, it can be as quick as 3 weeks, be a couple month deal. I do have a general checklist of items needed. So we'll just talk about a business acquisition real quick here. Business acquisition, we need 3 years of the seller's tax returns initially and a year to date. From you, we need 3 years of your tax returns. If you own any other businesses, we need 3 years of business tax returns. If you own any other businesses, we need a debt schedule. We need a resume. We need Form 413 filled out, which is a personal financial statement specific to the SBA. And I have all these forms for you. Resume, I said, and then projections. And that's really what we need to essentially assess the deal and get you a LOI, which is a letter of interest from the bank. So typically we can get those LOIs within 7 to 10 days, assuming we've got the seller's tax returns. Sellers often want to just give you P&Ls, just say, hey, look, I'm getting bank financing. They want the actual 3 years of business tax returns. So just to give you the heads up, they're always going to want that. A franchise startup's different. We're going to get projections. We're going to get the FDD, which is the franchise disclosure document. We're going to have you fill out the Form 413, the financial statement, 3 years of tax returns. But it's almost the same, just a few more documents or different documents. And then when we're doing a franchise startup or any kind of startup, we're going to have to build up the total project cost. We're going to have to, let's just look at a franchise startup. We're going to need to get the invoice for the truck you're going to lease, the 500 square foot office space. We need the, draft lease on that. We need to build that up because that's all our total project costs. All right. Sure. I'll dive into this business acquisition scenario. If the business has negative net last 4 years, but numbers are positive just this year, buyer has good credit score, 740 plus, seeking $4 million SBA loan. Do you think negative history of the business will make it hard to get the SBA loan? Thanks for any input. So yeah, that's going to make it a little bit more challenging. If there's a story behind it, and then there's also a good business plan on how this business is going to turn around, and if you or the borrower of this transaction is solid and has really good resume and has maybe it's a little weaker deal, but you got a lot of equity in some real estate, and we're going to collateralize that, and yeah, we can potentially look at it. Now we're like I said before, all banks are different. We're going to take it to a bank that likes this type of space, that likes the sponsor, the borrower. Sponsor, borrower, the same thing. But yes, it is possible. I just need to know more. But if like the borrower is, weak, that's going to be a more challenging deal. But it definitely is possible. Just need to know why, what happened to the business. I know COVID happened, a lot of things. And what the new buyer is going to do and how this is all going to change around. I'm going to dive into some other questions I had before we started this. I have a series of questions that I think are informative for you. But if anybody's interested in talking further, have deals they want to run by me, have a deal in contract, you can go to bookwithbo.com. It takes you to a calendar page. You just pick what you want to talk about. Financing, buying a franchise. If you want to go through our discovery process to figure out what franchise model might be the best for you or business model, we have a process for that. For financing, we have a calendar there. So just go to Book with Bo. It's all there. I was just at the Franchise Brokers Conference. There's a lot of opportunities out there. A lot of these service-based businesses, the total project cost, the initial investment range, including working capital, we have some at 90 to about 250,000. So if we can finance that with 10% equity injection, there's a lot of options out there. There's owner operator models. There's semi-passive models, which means you're going to have a general manager running the day-to-day. Some of these franchises are geared for that specifically. So this is kind of all the stuff we dive into. If you're looking at like a lot of people, they go and say, oh, I want to buy an existing business because it's already cash flowing, which is true and not true, right? A lot of times people buy businesses and then they take other people's headaches, right? Like if you've ever bought a rental property and, hey, it's getting $2,000 a month in rent. I'm buying it for 110,000. I'm going to cash flow so much. And then you take it over and what happens? There's problems, right? Same thing with business acquisition. Nothing's usually as easy as it appears. So a lot of these franchise models, they're going to be able to answer, what's the expectations for me to, cash flow and start cash flowing this startup. Some of them are very quick. Some of them, that's all the things you would be doing in your due diligence. So great process. I'm a big fan of franchise, especially for people that are coming from the W-2 world and have never owned a business, because you're getting the support and all that. You're getting marketing support. You're getting business support. You're getting systems and processes, versus you trying to start something and you don't maybe have those skills developed. So, and what I'm seeing now too is a lot of people in my real estate investing world, they're like, hey, I need to own an operating business. I see a lot of people transitioning into the franchise space as real estate tightens up a little bit. Listen, I'm a real estate guy. I love real estate. I'm going to always buy and own real estate. But as I dove into the business world, the business acquisition, these boring businesses that Cody Sanchez talks about, I see why. There's a whole world I didn't really get until the last several years, and as I dive into it and understand the opportunities. I mean, the franchise business brings in like 800 billion into the GDP. It's a huge industry. Most of us just think of the Jersey Mike subs, the Subways of the world, but there's a lot of service-based businesses that are recession resilient: HVAC companies, plumbing companies, drain companies, window covering companies, flooring companies, painting companies. And even if you think, oh, this is boring, I wouldn't want to own that business. We want you to know what you would do as the owner, not like, hey, I'm going to be the one painting the house. And that's where the mindset shift needs to take place. But go to Book with Bo. Happy to discuss anything you want as far as real estate or business or franchise. I'm going to hit, we got about another 10 minutes to go. If you have more questions, feel free to go in the Q&A. I do have some questions that were asked and I have them here. So I want to just go into, I thought some of them were good. Is it possible to have multiple SBA loans? And the answer is yes, you can. $5 million aggregate. However, there's another secret, which is called the SBA 504 Green. If you do that program, you can have up to $16.5 million of SBA aggregate financing, but we won't dive into that right now. If you're buying something a little bit bigger, let's say you're buying a business for $9 million, we can do a SBA financing 7A loan. We can also put let's just say it didn't have real estate. We can do a $5 million SBA loan, and it's called Para Pursue. And we can do up to $2.5 million conventional loan with that. So we can do about $7.5 million for business acquisitions in total proceeds. Now, if you're an experienced operator, there's a whole M&A world, mergers and acquisitions. We can do much bigger deals, but we're just mostly talking about SBA stuff right now. Yes, you can do hospitality properties. So I've got one guy right now. He started operating short-term rentals, residential, and then he bought a boutique motel. So as long as we can show a little bit of hospitality experience, boutique motels, where they come in and they put their Airbnb or short-term rental operations in, that's SBA eligible for sure. So definitely something that could be financed. I'm doing a couple of those right now. Understanding full standby, we talked about that. So full standby, once again, the seller's going to they're going to do a seller carry. On full standby means that they can't get whatever that portion. Now you can have the seller carry back two notes, one that's on a normal seller carry, and then 5% on full standby. And in full standby just simply means that there's going to be no payments due for the first 2 years. It can accrue interest, and then we take it out of the equation, and that looks like your equity in the deal. That's full standby. Mid-construction deals. So a gentleman was remodeling a motel, ran out of money. It's only partially operating. Strong borrower. We were able to come in with SBA financing to pay off the existing short-term debt and put the money together for the construction reserves that he needed, the shortfall. So you can also do value add type of deals with SBA real estate involved, renovations of a motel, etc. We talked about partial buyouts. Let's see. So you can also refinance SBA loans. So I think that's important. So you can, there's certain debts that are eligible, certain debts that are not eligible. Right now, we are doing refinances of SBA loans, get them better margins, better rates, extending amortization to reduce their monthly debt payments. So it is possible. So you could, so let me just give you another example. Self-storage facility. Guy wants to build a self-storage facility. Now, the project needs to be shovel ready, permits, everything needs to be ready to go, permits pulled, etc., before we can fund an SBA loan. So if you're trying to buy the land and then go get plans approved, SBA, you're not ready for SBA. So you're going to want to do an extended escrow, or you're going to get a bridge loan to buy the land, and then we're going to refinance, and then once we have plans approved. So we can't take the land down and then, wait to get plans approved. It's got to be ready. So there's strategies behind when you're doing, self-storage construction or a big renovation. So always remember, I've got one right now. They're leasing a 45 or 6,000 square feet, and they're putting a bunch of laundry facilities as a startup. But we need a good, reputable contractor. We got to be shovel ready to, to start construction. If we need to pull any permits, we need to have all the invoices, all that stuff. So when we talk about timing for these SBA deals, that's where the shortfall is like if we're waiting on the borrower to get all that stuff. So just remember, you got to be shovel ready. There are strategies behind it to do that. Sometimes I tell people to do extended escrow with the seller. Hey, we're going to close once we're shovel ready, and that's kind of a common thing. Or people take it down with bridge loans, a short-term loan. As long as the short-term is eligible for refinance with the SBA to be paid off, it's eligible debt. And sometimes people don't have, they have just normal business loans at really high rates. We're able to consolidate and do a refinance using SBA 7A, or if there's real estate, the 504.
Meet Bo Eckstein, the driving force behind Business Ownership Coach. Unlocking the path to business ownership. Visit www.businessownershipcoach.com. Thrive with Business Ownership Coach.
So anytime you do a commercial loan, so SBA, typically, like if you're using a PLP, which is just a direct approved lender for SBA, the bank, they're all going to have their own kind of reporting. Like when you do commercial bank loans, sometimes they want you to send financials yearly to them. That could be definitely a stipulation. This is not uncommon in the commercial finance world on like multifamily and different things like that. It's very typical. So on these business loans, sometimes they do want you to send annual tax returns in, or end of the year financials, but they usually don't. There's not too much oversight unless there's a problem and they're not getting their payments on time and so forth. Then their documents, they could be a little bit more strict. In like the multifamily space, for example, if occupancy goes under a certain amount and debt service drops, they can call the loan due. But typically, there may just be like an annual financials that they want. So that's pretty much it. So anyways, you guys can go to bookwithbo.com and feel free to schedule a call, and we could discuss SBA, franchise, business acquisition, or just getting a plan in general to like figure out what would make the most sense. What I'm doing personally is, so I've owned a franchise. I owned a franchise real estate company. I got out of that when I moved to Las Vegas. I've invested in 2 different business opportunities. They're not franchises. We call them business opportunities because they're not registered as a franchise. Currently, I'm looking at one franchise startup model. This year, we invested as a minority owner of a restaurant and RV type of business. We owned less than 20% of that, and we just provided some of the equity injections so they could close on their SBA loan. So I do a lot of this. I'm a real estate broker in California, Nevada salesperson. So a lot of real estate stuff, lot of business stuff. I'm taking my out-of-state rentals and selling those and moving that money probably into a business. I got to figure out from a tax standpoint. But, if you're looking for cash flow, I think, and you're limited as far as how much equity you have to put into these deals, I think you can't beat businesses. Now, a business is not just set it and forget it, right? There's more moving parts than owning a rental property that's professionally managed. But for me, I'm looking for more cash flow to build some operating businesses. So let's see here. I see Mr. Patel or Mrs. Patel. I have equipment loan. Can I get construction loan, SBA, or improvement loan? Which one applies for me? Yeah, you could potentially refinance that equipment loan if it's coming due. It's got to be eligible. So you could. I don't know if you're trying to build something. Can I get a construction loan? Yeah, I have to understand it more. Go to bookwithbo.com so we can set up an appointment so we can kind of talk about it. But that could be. Look, you can book a call with me. I can give you pretty good information. If I can't do it, I could probably tell you what I would recommend and figure it out from there. But yeah, I wanted to host this meeting just to share what SBA financing is all about. Maybe open up your mind to the possibilities, right? There's a lot of possibilities. Anyways, do me a favor. If you haven't subscribed to my podcast, go to YouTube. It's a YouTube show. And you can go in the search bar and put in Investor Financing Podcast and subscribe there. You could just go to investorfinancing.tv. And then we're also rolling out a new podcast where I'm going to interview. It's going to be more just more in the franchise business world, mostly franchise, but we're going to interview franchisors, introduce their business models to the world. And that podcast is called Own a Business Today podcast. It hasn't launched. It'll launch in the next 30 days. And I'll be sure to make sure everybody gets a link there. And those will be just deep dives on different business models. I love looking at different business models as well. So anyways, hope you guys enjoyed this. I was rambling on. Like I said, it's kind of hard to do these by myself. I just realized, but hope you got some nuggets out of it, and look forward to connecting with all of you. And thank you so much for joining. Hey guys, Bo Eckstein here. If you enjoyed what you saw, please subscribe to this channel. We talk all things financing. I've been in the lending industry for over 20 years, and I'm happy to answer your questions and provide great content.